Hey guys, I found this company, Synchronoss Technologies, to be quite interesting because it has a turnaround story that can 3x or even potentially 10x its share price, but of course with substantial risk involved. Let me quickly run through the company's business and share with you why I took up a position in it. Understand that Synchronoss is primarily in the B2B enterprise solutions market. It offers white label technology products and platforms to a range of customers, namely in the telecommunications, media and technology markets to serve their customers better. Their key customers include leading telecommunication companies like Verizon and AT&T. The company segregates its business into three operating segments as you can observe from the chart: cloud, messaging and digital. For its cloud platform, it gives operators and subscribers the ability to transfer and backup content across devices and operating systems. In addition to email solutions, Synchronoss messaging platform gives its customers the ability to offer rich communication services, or what we call RCS, to their own subscribers. This is like WeChat that goes beyond messaging to connect with merchants for commerce and transaction purposes, and thereby providing alternative revenue sources for these operators. As for its digital segment, it offers its customers a low-code environment to manage their own end-user facing applications with their own existing back-end systems. This will allow Synchronoss operator customers to better manage their own customer journeys more easily. Now let's take a look at why its share price has been depressed recently. So you see here, Synchronoss share price has plunged from a high of $40 range back in the late 2016 due to fraudulent accounting practices. We will not go through the whole story here, but it has since readjusted and is in a very different position now. However, plugged with a series of challenges alongside the company's restructuring activities to align resources to their new strategic priorities, the company's share price has remained depressed. In my view, there's two key reasons why. The first will be the preferred securities arrangement with Series Capital previously. With a 14.5% dividend requirement, the company has been repaying with more preferred stock in the past years, and this was effectively a debt snowballing over time. With such a high interest to pay, it's definitely not beneficial to its shareholders, and this is one key reason why Synchronoss share price is depressed in the recent years. However, on the 24th of June 2021, the company announced its plan to restructure and fully redeem its outstanding preferred equity arrangement from the cash obtained from new common shares offering worth $125 million and taking a debt of $125 million, as well as $75 million to be raised from preferred shares issuance to Riley Securities. With the new capital structure, the cost of capital will be reduced drastically from $40 million to $17 million as observed from the table here. This is a substantial cost savings of around $23 million. And it should provide a clearer path moving forward in terms of its debt and capital structure and allow Synchronoss to focus on growing its revenue and cutting costs. So this will clear out some uncertainties among investors moving ahead. The second reason for its depressed share price will be the company's declining revenue trend as observed from the chart here. This is indeed something to worry about. However, from what I understand, the company is trying to focus on building its recurring revenue base rather than one-off transaction, service or license fee. As a result, the reported revenue can be quite lumpy when compared across the years or quarters. As a result, it may take a while for Synchronoss to reverse its declining revenue trend while it works on increasing its recurring revenue drivers. However, we are seeing some positive signs. For instance, from its messaging business, its recurring revenue has been increasing steadily over the past few years as observed from the chart here. This is great because if Synchronoss can continue to grow its recurring revenue sustainably, its share price should benefit from a higher valuation as a SaaS company. However, its cloud business is not showing similar progress in its recurring revenue base in the recent quarters, so this is definitely something to monitor moving forward. Then again, on a positive note, we do see some wins in customers in the last 18 months alongside the renewals of the long-term contracts with its major customers like Verizon. Its latest win was associated with Telkom Sigma, which is an IT arm of Telkom Indonesia, Indonesia's state-owned telecommunications group. Yes, the deal associated with offering cloud solutions for up to 8 million students may not move the needle for Synchronoss, but it can be an important step for further collaboration to tap on Indonesia's population of 270 million people through the largest telco company in the country. While there's still uncertainty regarding to what extent such new deals can bring up the recurring revenue base of its cloud business, it seems that the company is at least moving in the right direction of its strategy. As you can observe from the table, Synchronoss subscriptions revenues are showing signs of strength, albeit its cloud contribution dropped slightly year on year. Apart from the strategic realignment and positive signs of Synchronoss' recurring revenue base, management have been trying to cut costs and expenses over the past few years, and they seem to have achieved their targets so far. This should improve earnings leverage and cash flow moving forward. In fact, in 2020 itself, the company realized an expense savings of approximately $45 million. All these incremental savings, however small, can change the bottom line and free cash flow drastically. Hence, it is a very important initiative to undertake to unlock value in the company's share price moving forward. Now, post restructuring of its capital structure and based on an illustrative share price of $2.42 a share, the enterprise value of Synchronoss will translate to $383 million. Coupled with management's forecasted adjusted EBITDA of $32 to $37 million, this will translate to a EV to EBITDA multiple of between 10.7 to 12.3. However, depending on when you are watching this video, the trading multiple may vary due to the change in its share price. As a matter of fact, after the announcement of its new capital structure, the share price increased to $3.50 range. It may seem weird at first as there's a massive dilution of its common shares. So the price action seems to indicate that the market has penalized its previous preferred stock arrangement substantially and thereby causing an overall upward reaction even upon the news of common shares issuance. Anyway, based on the share price of $3.50, it would have translated to an enterprise value of approximately $475 million. Consequently, its forward EV to EBITDA adjusted would range between 12.8 to 14.8 instead. At this valuation, I would say that it is pretty reasonable compared to its past as well as to its peers in the industry. However, based on what I see, the infrastructure is already in place. Those fixed costs associated with the initial heavy lifting to create the technologies and sales force where the business is built upon has already been in place. Any incremental growth and addition to the top line will translate to more than proportionate increase in profits or earnings, and this will create significant upside for its share price. On the other hand, given that the company's earnings will be sensitive to any change in its revenue, it may create substantial swings in the valuation matrix associated with its earnings. To illustrate my point, we will use the latest income statement for the fiscal year of 2020 as an example. Let's say if the company uses about 20% of its R&D expenses and 20% of its selling, general and administrative expenses for growth, meaning that we can potentially add about $33 million to the company's earnings if it is not investing for growth. Furthermore, as seen earlier, with the new capital structure, there will be a cost savings of about $23 million. Together, this $33 million growth capex plus the $23 million cost savings could result in a positive GAAP earnings. At the current share price of $3.50, meaning a market cap of about $300 million, a $10 million earnings will translate to a PE ratio of 30. Now say if the top line adds another $10 million, meaning a 3% increase in the revenue, and the management is able to cut another $10 million in cost, this will result in a $30 million bottom line. At a market cap of about $300 million, its PE ratio will become an attractive value of 10, and I think this scenario is highly possible. Again, although the company's management uses EV to adjusted EBITDA as a benchmark, I'm just using PE ratio for illustration purposes here. At this point in time, cost-cutting measures seems to be working. While revenue growth may still be uncertain, we see that the company is actively sourcing for new customers and projects. If Synchronoss continues to execute its strategy to grow its recurring revenue base while maintaining financial discipline and cutting costs whenever possible, an earnings of $60 million may not be too distant away. In fact, we saw the PE ratio of Synchronoss peers hovering at an average of 15. Hence, a $60 million earnings should translate to a market cap of $900 million. Therefore, I would say that the company's share price may not only 3x but also potentially 10x in a few years' time. Wildcards will include big deals that the company may land itself in, for instance, implementing the RCS messaging system for the US telco companies like AT&T and Verizon, just like how Synchronoss has successfully implemented for Japanese carriers. This will be a strong catalyst for its business and cause substantial price action to its share price. So, given the potential high reward coupled with the positive performance the company is showing recently in terms of growing its recurring revenue base and their successful cost-cutting measures, I will be adding a small position to my portfolio. As for now, be prepared to ride through the volatility of its share price and continue to monitor the progress of its revenue drivers growth and cost-cutting measures. Let me know your thoughts on this and share with us in the comments below, and remember to subscribe to our channel so that you can be informed once our next investing tip is out. In the meantime, check out the recommended videos here to continue learning so that you can make better investment decisions. Keep learning and happy investing, and we will see you soon.